Yes, indeed. Trading and post-trading issues have been a long time on the agenda. Even on the industry agenda, Sesame 1 is now over 15 years ago, and many issues haven't been resolved. But I think this time the Commission and the market have realized that the EU needs to do something and needs to do something fast to get its act together and improve especially the capital markets in the new form of this of the SIU, the Savings and Investment Union. There are really areas which can be addressed, for example, in the primary markets, improving of listing, making sure that more companies get an interest in listing and get listed, and we don't lose these listings then afterwards to the US. On trading, there will be reforms. The stock exchanges are looking proactively for getting a larger share in the retail market, and they have an argument that possibly some retail trading is not reaching them because it is repackaged as large orders and can therefore be executed off exchange. That could be an area where we see a part of the reform. On the post-trading side, there is an active discussion that we have too many CCPs and too many CSDs. They are, I guess, in the public eye not as important as the stock exchange, which is usually the national crown jewel. So there we could see that the number of CSDs might be reduced by market forces through consolidation, but that is an active process among the interested parties. On top of that, we will certainly see that the standards used and the procedures used will be unified, and that can be helped by regulatory encouragement. There's also a call today on the panel that T2S, the system which is already in place, should be rolled out really across all markets and all infrastructures. So there will be progress, but it will not be along the headlines suggested by some consultants. We will have, like in the US, only one CCP and one CSD for equities, and that's it. That is, I think, impossible given vested interest and market forces being at work. All these infrastructures currently do not rely on regulation to exist, but offer real services to market and therefore have market participants who want to use them. So it's not possible simply to get rid of them with the stroke of a pen of the regulator. I mean, these are two related but separate questions. The retail investor, every move towards more efficiency and cost savings at the infrastructure side, be it trading costs, be it post-trading costs, settlement costs, and asset servicing costs thereafter, will benefit the retail investor because they will reduce the cost amount which it has to be paid on each and every transaction. That is led by market forces. Natasha Kazanov from ESMA was explaining that they just issued a report on fund costs, where she also said that confirmed the EFAMA view that fund costs overall are already going down, even if slightly and maybe not fast enough, and that will obviously by all reforms be improved. On the measures against fragmentation and for more consolidation suggested in the consultations and in the Draghi and Letta reports on the trading and post-trading structure, the effect on retail, direct effect on retail investors will be probably most felt in those areas where we see since a few years increased interest of retail, which is direct, usually digital brokerage. The EU has prohibited the so-called payment for order flow with the latest MiFID reform, although the markets who had this in place benefit from a huge increase in the number of retail investors going digital. So it is important that the EU recognizes the important role of specific retail brokerage houses focusing on digital distribution, easy access and gamification in order to allow for more retail participation. And that needs to be flanked by allowing them to make money. I mean, the associations, both BVI and EFAMA, have been very supportive of these new technologies, also of the artificial intelligence technology. We have seen a number of years so-called proofs of concept, i.e. testing cases. We see now, I think, the move to the next stage that actually, especially in fund processing, tokenization is used. The first larger group of funds which are actually using that, and where it is a very active discussion, is the tokenization of money market funds. And one particular use is to use money market funds units in tokenized forms as collateral for clearing purposes. This is one case which is starting. There are a number of other cases which carefully have to be looked at, but it's not the case yet that we have a full move from the so-called traditional finance infrastructure towards the new decentralized finance structure. For that to happen, I think the new structure also needs to prove that it is not only resilient, but can handle large volumes and at a large volatility, which the traditional exchange systems and the traditional back office systems, backed also by SWIFT infrastructure, have demonstrated. And obviously with the blockchain technology, at least latency, i.e. being very fast, is not one of its advantages. So we carefully have to see the list of use cases developing forward, but I'm very optimistic and see also the fund industry in a leading role, because our fund processing, i.e. buying and selling units, is not as standardized as the buying and selling of equity on the stock exchange. And therefore, we as an industry need to move forward on automation based on standardization, and the DLT technology could be one way to actually achieve that.